Okay, in this video, I want to talk about stop losses. I wish I had the answer to stop losses. Um, I wish I can tell you this is what you need to do and you will always win this way, but that's not how stop losses work. Stop losses, your stop, every person has a different emotional attachment into trading and onto money and to how they do their stop. Okay. There are some people who have no problems being down one, two, $3,000 in a trade, and there's other people who are sweating and are freaked out when they're down $50 in a trade. So that's why it's all different between everybody. In fact, stop losses is what you should be focusing on more and analyzing more than your entries. Okay, the previous videos, I gave you 3 entries. Those are the 3 I use the most. Bob uses probably the most. Those are the types of entries that he looks for. And it's really the stop loss that makes or breaks a trader. It's not the entry. Okay, there is no such thing as a perfect entry. Okay, but you can get more perfect on your stop loss than you can on your entry. And this is really where you have to focus. When you get into a trade, you don't make money. Whether you are in the green or you're red, you have not made anything. It's as soon as you hit the exit button, as soon as you stop out, that is when you make or lose money. Okay, so that's why the stop is really the more important part. And hopefully by now you've learned that trading is the exact opposite in every way from what we would like normally think. Okay, so you would think, oh, I got to find the perfect entry. No, you got to find a good stop. The entry doesn't have to be perfect. Okay, but your stop has to be pretty darn good, and you have to be more precise with your stop than you do on your entry. Okay, I have learned several different ways of how to do a stop, and most of you have probably learned a few of these. A few of them I've kind of adapted a little bit more, um, but I want to kind of go over these 5 uh, types of stops. Okay, and this is more of an education. I'm not here to tell you what you should do. I'm not here to tell you how to do this. I am just going to educate you. And this is something that you have to figure out for yourself. All right. And you might not just choose one. You might not say, I just want to use this stop. There might be a few of these stops that you like for the type of trade you take, whether it's a momentum trade or if it's a pullback trade, or if it's off of a 95% trade, you might use a different stop in each case. And again, I'm not going to tell you which stop you use, right? Some of you want me to tell you what to do, and I'm not going to because that's not how you become a good trader. And also, what works for me is not going to work for you. I have no problem in taking $1,000, and being down $1,000 at a time or $2,000 at a time. Okay, it also really depends on the size of your account. All right, I've learned throughout the years you really cannot be trading an account that's $3,000, $4,000. You need to have a substantial account, okay, because you are going to have stops, and you have to get over this feeling of if you're down $50 that you are automatically out. You have to think like a trader. Traders don't think that way. All right, traders think about being consistent, finding the perfect finding their entries and getting in and putting in smart stops. Okay, it's not about trying to find a perfect trade, and if you're automatically in the red, you get out and you start freaking out. That's not how you become a trader. Okay, you have to get in the flow of the market, and you have to understand what the market is trying to tell you. There could be times you're down $1,000, but if the market's still telling you, hey, I am long, all right, the market wants to go up and you're long, you're like, I'm fine. I know that the market's going to go up. It just has to do more of a pullback. So why am I going to get out? All right. Well, if you can't handle being down more than $200, then obviously you should probably get out and wait for your next entry point. Okay. So again, just to restate this, every person has their own. I'm not sure what the word I'm looking for, but they have a limit on themselves, how much they are willing to actually lose or be down at one time. And that's something that you have to focus on and you have to learn for yourself. So I'm going to talk about these 5 types. The first one is a dollar value stop loss, which is probably the one that everybody knows and everyone learns and it's all taught. I honestly think it is probably the worst way of doing a stop because it makes no sense at all. All right, so we'll kind of talk about that. We'll talk about a technical point or level. This is kind of the one that Bob uses probably the most. He'll kind of find a level and say, I'm going to put my stop underneath here. And it's probably the one that makes the most sense. And then here's one that I knew a trader that used. It's kind of a hybrid of the dollar value and of the technical point and level. And it's more of an entry rather than a stop. However, it takes all of the pros of your dollar value stop and of our technical point stop, and it puts it all into one, and it gives you this hybrid approach. This is probably something that you've never seen before, but it makes sense. But again, it has its own pros and cons as well. The fourth one is a turn of the market. So if you're going long and then all of a sudden you see sellers like coming in, why wait for your stop to be hit? Just get out. All right, Bob uses this as well. He'll say, keep your finger on the close button. Keep your finger on the close. If this doesn't go, I'm out. All right, so when he says that, this is the type of stop he's talking about. Then there's this averaging in. This, I'm going to talk about this. There's lots of ways of how to average in. You've probably heard a lot of people say, oh, you never average in. I've heard that. And you have to think to yourself, the person who told you that, are they a successful trader? Are they one of those websites that tell you you never average in, don't ever do that, but you're no longer with that website because they turned out to be a phony? Well, you have to think about this. You have to think about, is averaging in really I've been taught, oh, don't even think about averaging in. Just kind of get that out of your mind and just try to find another stop. There's a time and place for averaging in. And I'm going to talk about, I think, a very safe way of doing it. This might not be for everybody, okay? But then again, you might start thinking about this, like that's kind of an interesting way of doing it. And it could be a very safe way of doing it. But again, I'm educating you. I'm not telling you what to do. I'm going to give you the pros and cons for all of these. Okay, so let's first talk about the dollar value. Okay, now my slides are not fancy in any way. I just want to get to the point. So if you're looking at this like that is very boring, you're probably right. It is very boring. But I just want to get the facts, just the facts, ma'am. All right, many of you have heard that term before. All right, so the dollar value, it's basically you have a certain amount of money that you want to lose. You don't want to lose any more. Like if it's either 1% of your capital, or if you're like, I'm okay with losing like $200 on a trade, whatever that number is, whatever that percentage is, how many ticks, I will get out if I'm down 15 ticks. After 15 ticks, I'm out of there. Okay, so you have a set amount. You always know how much you're going to lose. Okay. However, it's random. You're just putting a stop at a certain place. That's a very random place to actually have a stop. It makes no sense. Okay, why do I put it at $10? Just because I don't want to lose more than $200? Well, remember, we're trading a market. We're not trading, I don't know, a certain amount of a money value. We're trading a market. Markets, especially in the NASDAQ these days, it can have these huge swings back and forth, but that doesn't mean it's going the opposite way. All right. How many of you have been in a trade and then all of a sudden the market just it swung one way or the other and it got you stopped out because your stop is only at 10 ticks, but the range of the market is like 100 ticks. Okay. So a dollar value, my opinion, is the one thing that most of these websites teach because it's safe, it's easy, it's easy to understand, but I think it's probably one of the worst ways of doing a stop. But again, I'm giving you my opinions, but you might think, you know what, no, I don't want to lose more than $200, which is fine. I'm going to actually show you ways that actually might make more sense, okay? The next one, number 2 on the list, is a technical point or level, and this is what Bob used, and this I think makes more sense. You're okay, so imagine you're in a trade, okay? Well, where do you put your stop? Well, you put your stop at a place where the market has a good chance of reversing on you. So if you're going long, don't you think a good place to actually put your stop is a level in which the market then will start going down? So if you're long, put your stop at a place where you would normally go short at, okay? And there's lots of places. It's either at a swing level. So if I'm going long, it's underneath a swing level. It's either above or below, depending on if you're going long or short. Or at a specific support and resistance level, like a value area or a VWAP, all right? Or right behind previous buyers or sellers, or a stacked imbalance. So find a stacked imbalance and hide your stop underneath them. Because if you're going long and you have a stacked imbalance at a certain point, the likelihood of the price hitting that at that area and going back up, you have a good chance of doing that. So if you hide it right behind all of the imbalances, you have a pretty good place of putting a stop. Okay, so these are great places. These are places that make sense. It's not just random. It's not just at 10, at 10 ticks. However, sometimes it could be pretty large. It could be 20 ticks, could be 30 ticks. Occasionally, Bob will say, if you enter here, your stop, you guys are not going to like this, but your stop is, 75 ticks away. Eeks. All right. But he says, look, this is where your stop is because this is the stop that makes sense. It's the area at which the market is going to reverse. So I want to kind of give you a picture and kind of show you kind of what I've talked about like so far. Okay, so this is gold, I believe. Let's say you have an entry. So everything in yellow right here are kind of showing you where our stops in the entry is. So let's imagine this is our entry at this price right here. It doesn't really matter what the price is. Okay, so first of all, let's talk about why I'm taking this entry. Okay, let's kind of go back to our entries. All right, so let's review. Number one, I am long. Why am I long? Because this is green. Okay, I am green, so I'm looking for a long. Notice the price is starting to break above VWAP. So this is a momentum trade. I am taking a momentum trade. It's breaking above VWAP, and I'm going to look for some stacked imbalances. Now, this is after the fact, but at the time, there might have been some stacked imbalances. If you notice that this is kind of green, at the time, you probably had stacked imbalances. You might not have, but let's just assume you did have stacked imbalances. This really isn't about the entry, it's more about the exit. But let's say this is one of our entries. I'm doing a momentum entry right here. All right, we're breaking above VWAP. We are green. Let's assume I had stacked imbalances. I do have some imbalance here, but let's say I had a whole bunch of stacked imbalances and I entered right here. Okay, so I entered right here. It goes like 2 ticks. Obviously, I'm not going to take profit after 2 ticks. And then it goes against me, and it keeps going against me. Well, this price right here is our 10 ticks. So let's say I don't want to take more than like 10 ticks. That is where I would get. So obviously, I would have gotten stopped out if I just had my stop right here. This is my first stop, a certain amount, 10 ticks, end of story. This is very random. Like, what is so special about there? Absolutely nothing. Okay, if I'm trying to read the market, I'm trying to get into the flow of the market, there is no flow, there is no reading. It's just a random 10 tick. There you go, I'm out. That makes no sense. Okay, that makes no sense at all. Okay, now let's talk about on the next slide. Okay, the next slide I talk about a technical level. Now there's lots of different ways you can do that. You can either do underneath the previous swing, which would be right here. So if we entered here, my previous swing was down here. Okay, so that means 1 or 2 ticks underneath this previous swing, which would have been right here. So I would have been stopped out. Okay, but notice it didn't get there, and then it comes back up, probably goes maybe, another tick or so above it. Actually, it looks like it's about the same. It's 2 ticks, but notice it's coming back up. All right, but then eventually it gets out. Now, you might have changed your stop and maybe said, you know what, if it goes, so maybe you had your stop here, it comes up, this technically now is my new swing level. So maybe I'll hide behind here if it breaks here. Now my stop is only 11 ticks. But notice originally you're probably down 20 ticks. So if you got stopped out, that's about a 20 tick stop out. Okay, well, your stop doesn't necessarily have to be the swing level because look at how green I am. I'm really long. I'm sitting here thinking this is long. Like, so what if it pulls back? Okay, so maybe I would hide my stop behind the value area rather than behind the swing level. So maybe I can put my stop a few ticks underneath the value area low, because what if this now started breaking my value area low? What now are you thinking in your mind? Right now, you should be thinking, I am below VWAP. I'm breaking now the value area low. And look at my delta. My delta is 81 now. I'm getting close to actually red. Okay? So this is probably the area that would make the most sense to have your stop. This is a stop that makes sense. It's underneath a support and resistance level at a place where I would expect this to actually now start going down. This is the area where I think the market would actually short. Okay, so again, let's repeat why I think that would short. All right, because it's underneath the VWAP, it's a value area low. If it does break this, where's it going to go? Probably down to my value area 95. So I am not going to take that much of a loss. I mean, that's we're at 92 here to 88, so 4 handles, so like $400 per contract. So if you're in 3 contracts, that's about 1,200 bucks. Ouch. Okay, so this is what I mean by is having a stop somewhere that makes sense. Okay, now that is kind of a lot of money. All right, we're talking, you know, like $600 or $700, but this is what makes sense. This is what trading is about. It's not just having a random 10 tick stop. It's having a stop that makes sense. Is it at a swing level? Does this level make sense? Well, at the time, it looks like I had a green area here. So maybe underneath that, maybe that does make sense. All right, and you know what? There is nothing wrong with taking a stop, all right, and then waiting for it to come back here again. And notice I'm getting more stacked imbalances. It's turning green. Hey, you know what? Maybe the long wasn't here, but I'll take the long here. And now, sure enough, I did make it. So there's nothing wrong with taking a stop loss, all right, and then waiting for it to come back, because maybe it does come down here and it turns red, and now I'm going shorts and I'm going to make money on the short. Okay, but you should have it at a place that makes sense. This, like 10 tick, is a random area that does not make sense. Have it somewhere where you're actually at a support and resistance level. Okay, so again, it can either be a swing, it could be a value area, it could be maybe even underneath this green area. Maybe you're like, I don't mind like being down $1,000 or $2,000. So you know what? Let me have it underneath the 95. But now we're really far away. It's going to have to come all the way back up again. Okay. So let me talk about the third one. So far, let me go back to my first chart. I've talked about the dollar value. If you just want to lose $100, the technical point is kind of that chart that I was showing you. Have it at a place that makes sense. However, sometimes it could be a lot of money. All right, like I said, if you are coming down here and it gets stopped out, we're in the 90s. We're about 200. We're about like $600 here down if you're in 3 contracts. However, the one I want to talk about is a hybrid. Okay, and I knew a trader that used this. This was the most patient individual that I have ever met in my life. He would take maybe 1 trade a day, but he would make money on it because this is what he would use. And this is more of an entry than it is of an exit. Okay, so if you think about our last 2 examples, the first one is a dollar amount. So let's say you only want to lose $200. That's the pro. Okay, but the con is it's random. The next example I gave you is that the areas made sense, but you could be losing $600, $700, $800, maybe $1,200. You're losing a lot of money. So what if you combine the 2 and take the pros of them both? So I only lose $200 and my exit is at a position that makes sense. So I use both. So my stop is still at the area that makes sense at a support and resistance level, but I enter at a position that only allows me, if it hits my stop, to only hit at $200. Okay, so let me read this and then I'll show you the example. So you base your entry on your stop. You don't base your stop on the entry. You will always lose the same amount. You'll lose $200 or however much you want to lose. You still have a good place for a stop, but you're going to miss a lot of trades. Okay, So let's go back into this example. All right. So let's say you wanted to take this trade and you're going to put your stop down here. Okay. Now, this might not be a good place to enter. What this is saying is if this is my stop, okay, in my mind, if the market goes below the 68% level, I am going, okay, I assume it's going to go short. However, I don't want to enter here and have, an $800 loss. I only want a $200 loss. So my entry is going to be maybe like 10 ticks away from my stop. So my entry now is somewhere over here, okay? Or what you're doing is a pullback trade. Let's say I want to do a pullback trade and I want to buy at VWAP. Well, you don't buy at VWAP. If your stop is down here, you count up your 10 ticks and say, this is where I want to enter. Because here's my stop. My stop is here. This is where my stop is going to be. So my entry is at the 10 ticks above it. So let's say my entry is at 89.9. Let's say 89.9. So my entry is going to be at 90.9, at 10 ticks above it. So 90.9 looks like would be roughly around here. Okay, does that make sense? Let's see, 89.9, 90.9, yeah. So this is my entry. So rather than having my entry up here on a pullback trade, if I had my entry here, my stop would be down here, okay? But that's a pretty large stop. So rather than doing that, I'd say, you know what? I'm going to bring my entry down so that it's 10 ticks away from my stop. Rather than entering here and putting my stop here, okay, I still keep my stop here, but my entry now comes down much further, and it's only like 10 or 15 ticks away from my stop. Okay, so that's why this is more of an entry. It's kind of like the best of our both worlds. This is my stop, but my entry is going to be right here. Now, does that make sense? Okay, well, I mean, how many of these trades are you going to make? How many times do you think it breaks below VWAP and it reverses? It usually reverses at VWAP. Okay, well, you might miss a lot of trades, but in this case, if you took that trade, you would have made money. You would have been in great position. All right, even if it came down here again, maybe you would take it again. Again, Bob says you never take a second touch, okay, which I agree with him on that. But in this case, you would have entered right down here and your stop would have been down here. Okay, my stop would have made sense and my entry and I would only be like 10 ticks away. So I'm waiting for more of a deeper like pullback. Okay, Bob, what he teaches and what I've taught in your video is that your entry would be at VWAP. I would wait for the pullback at VWAP. All right, or wait for it to kind of start to go above VWAP and wait for my stacked imbalances. Well, these are kind of way too high. It might be like, I don't want to have, a 30 tick stop. I only want a 10 tick stop. Well, if that's the case, this is your entry point, not up here. It's down here since that's my stop. So your stop tells you where your entry is rather than getting into a trade and then trying to figure out where your stop is. First, you figure out where your stop is. Like I'm looking at this and thinking, the gold market is long, okay? It is long. I'm going to take, buys at the pullbacks at these areas. Well, however, if it breaks below my 68%, then I'm probably in shorts at that point. All right, it's probably going to come down to 95. So you know what? I'm going to put a stop right underneath there. I don't want to go long if it's going to break this area. So therefore, I'll count like 10 ticks and say, all right, this is where my entry is now. It's not at VWAP, it's right here. Now, at times, it could be at VWAP. Those are great trades. If my VWAP just happened to be right there, then I'm great. I'm taking a 10 tick loss. I have a great area, and it's bouncing off of VWAP. It's no problem. Okay, but you can see how this can miss a lot of trades because you might hit the VWAP and then go. Okay, in this case it didn't because I wanted to show you an example of where it would work. Okay, so that's the hybrid trade. It takes the our pro or our best thing about the our certain value stop, all right, if I only want to lose $200 or whatever, and it takes our best of the stop at a certain level that makes sense, okay? So that's the hybrid. And I knew a trader did it. He missed tons of trades, but you know what? He was very high probability trader. All right, he was greater than 80, 85% because he took deep, like pullbacks. All right, and his stops were very small, and he would usually make a lot of money on those. All right, but you got to be patient. You have to be trading all day. I have a full-time job. I have maybe about an hour and a half to 2 hours at the most every morning to trade. So I need to get a trade. I want to get a trade. All right, I want to get into trades and I want to get, a few good trades in the morning so that I have money. I don't have all day in order to sit and watch all the markets. Okay, the third type is when the market will turn against you. And Bob uses a lot. This is when Bob says, keep your finger on the close button. All right, I'm going to kill it if it doesn't go in my way. Okay, and this uses order flow to figure out your stops. It's not a support and resistance level. And you can actually use this in conjunction with the other ones I've taught you. It's not like you just do this one. You could, but this might actually be a good one to actually use in conjunction with the other ones I talked about. Usually you have very small losses, okay, because as soon as the market turns against you, you get out. It could be 3 ticks, 4 ticks at the most. Okay, it could be more, but at times it could only be like 3 or 4 ticks. However, one of the cons is that you might see the stacked imbalances occur and you get out, and then immediately the market stops and then it goes in your direction and you just got out of a winning trade. But you know what? You can always re-enter. That's the one thing people don't think they can do. Oh, I got stopped out of trade, I need to move on. Well, no, if you think the market's going to go up, it might just not be ready. All right, you might have picked it too early. It still might go up. It just might not have been ready. So why am I going to sit in this market and be watching and being stressed out if there's a possibility I'm going to lose money? Just get out and wait for it to tell you, okay, now I'm ready to actually go. Okay, so there's nothing wrong with doing that. Okay, so here's an example. Okay, so here's VWAP. All right, our blue line is VWAP. Okay, so this is an example of a momentum trade again. You see we have green. All right, so we're going longs. See how the market is underneath VWAP. It now pulls above VWAP. I have some stacked imbalances, especially above the VWAP. So let's say I get in right here. I'm going long. And then immediately it turns against me, and I see some imbalances. I'm like, uh-oh, market doesn't look like it's going my direction. It tries to go up, and then boom, look at that, 6 stacked imbalances. What should you be thinking at this point? Should you be thinking, I hope this goes back up, I pray this goes back up, or you think to yourself, I'm going to get out of this? All right, apparently the sellers are coming in pretty hard. Okay, I don't see any stacked imbalances like that with buyers, especially if you saw that bar. But maybe you just had that and then you see how it's starting to come up. And then the buyers are starting to come back up here. All right, so that would make me think that it's a momentum trade. It's going to bust up and go up to either our POC, or I obviously have an unfinished auction right here, or at the value area. But then I see all these stacked sellers. All right, I think does that say 100? No, it's just 97. But if you look at my bar delta minus 542, I don't have anything that size in any of these. So that's telling me sellers are coming in. Why do I need to stay? Let me get out. And if I exit out of here, if I entered up here, we're only talking 1, 2, 3, 4, 5, maybe 6 or 7 ticks at the most. All right, why stay in there until I go, or maybe what you originally had is your stop down here at the value area, right? Like how I talked about previously. Maybe it's down here. Okay, so why wait all of that and get stopped out? That would be like a 200 tick stop. I'm getting out at 5 ticks. And you never know. What might happen is the market might start turning back up, and then you get more stacked imbalances, and then boom, it breaks out, especially since I have a double high right here. It could be that it breaks out. Bob would call this a bang bang trade because we have 2 bars that stopped exactly at the same price. All right, so there could be a possibility it would break out and go up to the value area. So I lose 5 ticks, maybe like 6 ticks here, but then I'd make it right back over there. Okay, so this is kind of one of those trades. Bob might take a long here and say, guys, if it doesn't go, I'm out of here. I'm going to kill it. He would probably see this and kill it. All right, but maybe if you didn't or something and it came back up and you saw some buyers and then 6 stacked in balance, just get out. There's no point in staying in that trade. Okay. Finally, the dollar cost averaging. Okay. Now, if you're sitting there saying, I don't even want to listen to this, I was told averaging is the worst, I'm not even going to pay attention. Well, you are missing out. Okay. You need to be educated. You need to educate yourself on the types of stops. Now, there might be a lot of others out there. I don't really know what other ones there are. They're probably a variation of the ones I've talked about. But I think within all these that I've talked about, these probably give you a good idea of what kind of stop you might want to use. But let me talk about the cost averaging in. Okay, Bob trades with 3 contracts. Okay, well, whoever said you have to trade 3 contracts? Okay, I don't like trading 3 contracts at once because I don't like taking a big loss at $600 or $700 or $800. All right, 300 contracts at once, that's hard for me to take, especially at the beginning. Now I've been doing this for a while, it's not so bad. But at the beginning, I'm like, I don't have a huge account, or maybe I'm in like the top step, and the top step only allows me to actually trade 3 contracts. So so if I'm in at all 3 of them, or maybe I'm in a top step account, I can only trade like 2 contracts. All right, or whatever the reason is, 3 contracts in your mind might be a lot. All right, or when Bob says, well, my stop is 20 ticks, I'm going to take a $600 loss. Ouch, I don't want to do that. Okay, well, there's nothing wrong with trading a single contract. Okay, so let me talk about what this cost averaging is and probably a good way to actually do it. But again, this is something you have to figure if it works for your account. You have to think about your account. If you have a small account, this might not be like the best thing to actually do. Okay, the first thing is you're going to scale down your contract size. Rather than trading the 3 contracts that Bob does immediately, you only trade 1 contract. That's it, 1 contract. Okay, so if you already think about that, you're already cutting everything in a third. All right, so yes, your winner is only going to make a third, but your loser is only going to lose a third. Okay, you always have to remember this isn't about, well, okay, I'm going to say something that kind of isn't going to make sense. This isn't about making money. Everyone, yes, obviously at the end result it is about making money, but that's not the attitude you have to have. The attitude is being a consistent trader, is being a smart trader, is learning how to do this. Once you learn how to do it and you get in the flow, then you start making the money. Until then, don't expect to actually just all of a sudden just start making money. All right, this isn't easy. This is hard to do. All right, and there's a lot of information I'm giving you, and you have to kind of figure out what works for you. All right, so the first thing is don't worry about the money. Just try to get consistent. Just end the day green, whether it's $5 or $5,000. Who cares how much it is? Just be green every single day, and then eventually the money is going to come to you. Okay, so scale down to a single contract. In fact, you might want to trade the YM. That's why I like trading the YM, because the YM is every tick is $5. GC and CL is $10. It's twice the amount. All right, so as soon as I started trading YM, I wasn't as concerned about my stops. I was more focused on making sure I was trading smartly and I was in the flow of the market. I wasn't so stressed about, I'm down 4 ticks, I'm down $40. If I was down 4 ticks on YM, it's only $20. Okay, so as soon as I switched over into YM, that's kind of why I like YM. 1, I think it moves great, but 2, it's because it's a very small amount. All right, NQ is also $5, but boy, you get huge swings. So if you're still having issues, I recommend trading YM. I also had a trader tell me once he had people that he would teach how to trade, and as soon as they switched over into YM, they started becoming a successful trader because they were trading an instrument where they were only losing like $5 a contract. It wasn't a big hit. So that's kind of like my shtick on YM. Okay, so let me continue. So one, scale down to only a single contract. Okay, and what you're going to do is you're going to average in at, all right, another contract at the next obvious level. You're not going to put your stop there. You're going to average in, because if you only want to lose, let's say $300, all right, and you're only in one contract, okay, so if you're in, even if you're in like CL and you want to lose only $300, your stop now is 30 ticks away. You've got a lot of room here, okay? So what you're going to do is, rather than at the next level, rather than having your stop there, you have a limit buy there if you're going long, or a limit short if you're going short. Have another contract there. How many times has Bob been in a trade? All right, he gets in, it goes against him. It hits his stop, which, remember, his stops are at these obvious support and resistance level. It hits his stop to the tick, and then the market goes right back up to his original entry and more. And he's like, I would have made money if I didn't get stopped out. It got me to that tick. You know, how many times has that happened? A lot. It happens a lot. Okay, so rather than getting in at 3 contracts at once and being stopped out at 3 contracts, just get in 1 contract. All right, and if it goes down where Bob would normally get like stopped out, you're actually in getting in, but you're only down half the amount of what like Bob is down. Actually, a third of the amount of what Bob is down. So Bob is down like $600. You might at that time only be down like $200, or if you're in YM, only $100. So why not add a contract at that point? Okay, and this will allow you to actually increase your stop loss. So if you're okay with losing like $600, your stop loss is 30 ticks away. Okay, I'm sorry, is 60 ticks, especially if you're only losing like $60. I'm sorry, $600. So only go in 1 contract, average in at the obvious level that would be a normal stop. This also prevents you from getting whipped in noise. So if you're going back and forth in noise and you get in and it goes against you like 10 ticks and you have a 10 tick stop, then you get stopped out. Well, if you put your stop at 30 ticks, you don't have to worry about noise. Okay. You will still only lose your max amount. So if you only want to lose like $500, okay, well, if you're in 1 contract, you technically can go down 50 contracts. Well, if you average in, obviously you're gonna have to move your stop, but you've already allowed that market that freedom. It's allowing the market more freedom. It's not being like so, you know, like as tight. Because if you're tight, you're more stressed. It's more like I have to find the perfect entry. There is no such thing as a perfect entry. This averaging in allows you that flexibility. Okay. However, the one con is that since like 70 to 75% of your trades might be successful, you're only making a small amount anytime that you have a first winner. So if you get into a trade, it might go and you win and you make money, but it's a third of the size. But like I said, you have to get over the amount of money you're winning. You have to trade smart. That's what your #1 rule is. It's not to make money, it's to trade smart. If you trade smart, you will make money. Okay, so let me kind of show you an example of what I'm talking about in averaging in. Okay, so here's YM. All right, so let's say, so notice we're green. Okay, so right here we're green, and the market opens, and the market comes down like to VWAP, and I'm thinking, hey, VWAP is a good place to actually buy. Okay, all right, so I'm looking for, I'm sorry, not VWAP. Yeah, actually I wait for the first 5 minutes to actually occur. All right, and I'm green, and I'm thinking, all right, I want to buy, so maybe I'm going to buy at a pullback at our value area. Okay, or even if you did it at VWAP, it doesn't really matter. Okay, so our obvious stop, so let's say I put in a long right here. Okay, actually, if you did put a long right here, you would have made money. Okay, because it would have hit there, would have came down, and then it would have went right back up, and you would hit the 68% level. So even if you put a long there, you would have made money. But let's say I put a long here also, because at the time this would have still been green. All right, so I'm coming down at the 68%. I'm going to put a long here, a pullback trade, especially if you see this kind of grayish area. At the time it was green. All right, we're also at a low volume node. I haven't talked a lot about that. I talked about it, I think, in video 2. But for those of you that know the volume profile, I'm at a low volume node. So that looks like a good place to actually go long. So let's say I go long one contract. My stop would probably be like underneath our value area over here if I was going long. Okay, probably underneath our value area 95. Well, if I'm only in one contract, okay, especially at the YM, all right, this is about 20 ticks, so this is $100. If I got here and it went down, I'd only be down $100. Think about that. In the grand scheme of things, $100 is nothing. Okay. However, I know this is a rejection area. So what if I were to put another limit buy order at 95? It would have hit here. I would have been in, and I would have averaged in. I would have been in up here, and I would have been here, and I would have averaged somewhere in the middle. Okay. Well, what happened? Obviously, it reversed, and it went into profit like 10 ticks. Okay, now I don't know what happened. I believe this market did eventually make it up to VWAP, especially if you look, we have a lot of these at the same price. I believe it busted through eventually and it made it up to VWAP. Okay, so you would have been profitable. All right, no, if you're in 3 contracts here and you put your stop underneath or 95, you'd have been stopped out at 3 contracts. Okay, and when I say this is about 20 ticks, all right, so you've been stopped out at $300. All right, because I would be coming down, you'd be at $300 thinking, I'm at the point where I don't want to be down $300. All right, but if you're in one contract, it's only $100. All right, it's giving you more flexibility because technically my stop would be way down here if I was willing to lose like $300. Okay, but you put in another buy here and you average your price. So you'd be here plus here, your average price would be at 10 ticks, so at 15 approximately, so right around here. All right, so you notice it would hit, it would have went above it, I don't know, however many ticks. I like to scalp at it, so I probably would have scalped at this and I would have made profit. I wouldn't have gotten stopped out. Okay, so you might be thinking, well, where would my stop be? Well, again, go back to numbers 1, 2, 3, or 4. Okay, how much do you want to lose? If you just want to lose $300, well, if I'm only in one contract, all right, $300 is 60 points away. All right, but if you get into a second contract, well, now you have to move that stop up a little bit more. Okay, so you have to do a little bit of math. All right, but I want you just to understand what averaging in. There's nothing wrong with averaging in if you do it smartly. Okay, if you do it based on everything we talked about. If you're averaging in 3 contracts every single time, you better have a pretty darn large account. Okay, but you know what? There's no reason why you have to be trading 3 contracts. Go down to a single contract and try the averaging in. Obviously, try it on a sim account. Okay, but you still have a stop, and your stop might be, I only want to lose $200. I want to lose $300. Okay, number one, do it on a $5 instrument because it gives you tons of flexibility. Okay, it gives you much more flexibility and you don't stress as much. You want to get over the stressing. Once you have a large account, then go to gold, go to oil. You might want to go to ES. I know a lot of people like ES because you can make $12.50 per, like contract. All right. Well, who cares? All right. If it only moves 3 ticks within a half hour, I'm not really making much. All right. Trade things that actually move. All right. I mean, if you want to make more per tick, then trade bonds. What is that? $31.25 per tick. All right, but that moves 2 ticks every 4 hours. Okay. So this is it's something to think about. All right. Averaging. There's nothing wrong with averaging in. But like I said, scale down your contracts and maybe even try it on an instrument that that is only $5 a contract rather than $10 or $12.50 or so forth and so on. Okay. Okay, so this is kind of a summary of everything I've talked about. I know it's a lot of information, but like I said, a lot of you probably know it. There might be stuff in here that you've never even thought about and be like, oh my goodness, that's kind of neat, or stuff I'm like, I don't even want to, that's not something I would even care about. Okay, so let's kind of go over the pros and cons real quick. Dollar value. Okay, pro, you have a maximum amount. I want to lose 200 bucks. That's how much you lose. End of story. I don't have to worry about anything. The con is that it really makes no sense as to where your stop is. There's no rhyme or reason. Most likely, it's going to get hit. Okay, it's going to get hit because your 10 ticks. A lot of the professional traders look for stops. They run stops, and they know you have stops 10 ticks away, 15 ticks away, 20 ticks away. So if there's like a breakout, all right, pros will purposely run it down somewhere between 10 to 25 like ticks away just in order to get all those stops. Okay, because they know you just have these 10, stops at 10 ticks or 15 or ticks or 25 ticks. Okay, there's no rhyme or reason. A technical pointer level, the stops can be a little bit larger. Usually they are. Okay. I'm sorry. Yes, it could be large. No, the pro is not a larger stop. The pro is that it makes sense. It's an area that it makes sense. That should say makes sense, not larger stops. All right. This should be there. I made a mistake. I'll fix the slide. All right. So um, the pro for a technical area is that it makes sense. It's an area where you have a reversal point. So if you're going long, you put your stop at an area where it will start to go short. Okay, it makes sense. Okay, the hybrid is our best of these two things. All right, the power of video, I paused it and I changed it. Look at that. You didn't even know I did that. Okay, so it makes sense. All right, so the hybrid is the best of both worlds. It's more of an entry than it is of an exit. My exit is still at the technical point level, but my entry is at a point which gives me a dollar value of what I want it to be at, $200 or whatever. It's the best of both worlds. But the con is that you're going to miss a lot of trades. All right, the next one I talked about is where you have a turn of the market. You either have stack sellers or buyers, depending if you're going long or short. All right, so if you're going long and all of a sudden you see stacked imbalances, 4 or 5 or 6 stacked imbalances of short, just get out of it. All right, so the pro is usually your losses are small because it starts turning almost immediately. All right, and you don't have to wait for it to hit one of these stops. You actually are getting out before it hits any of these stops that you did previously. All right, but what might happen is you might get out and lose, whatever, like 50 bucks, but then all of a sudden it turns against you, it turns and it goes in the direction that you wanted. But again, don't worry about it because you can always re-enter a trade. There's this stigma that we've been taught, like, once the trade goes against you, that's it, move on, the trade's done with. Trade's not done with. It just might be that you were too early. Okay. And then finally, the last one is a dollar cost averaging. This is not for everybody. However, the pro is that your stops are a lot larger. Okay, you don't have to have a 10 tick or 20 tick. You can have a 60 tick stop, okay, or whatever you feel more comfortable with. And you are bringing down your amount of contracts, which, believe it or not, is a pro. Okay, it's not a con. For some people, it's a pro. A lot of you need to be trading less contracts. When I started trading the 3, 5, 6 contracts with a small account, I would blow up my account very quickly. And once I realized I have no business to be trading that many contracts with the size account I have, as soon as I did that, it changed everything. All right. However, the one con is that you make less on first winners. What I mean by that is that if you get in on a pullback trade or something and it goes in your direction and you have a winning trade, it's only on a single contract. All right, is that really a con? Some people think it is. I wish I was there 3 contracts. Well, you know what? If you do this enough times and you make money every day and you're profitable, you can eventually go up to 3 contracts. All right, so don't think that you can't increase your contracts. Remember, the name of the game is being consistent and making money every day. All right, I hope this helped. I know a lot of people have been asking me about stops, and like I said, I do not have an answer for you. Okay, I like these. I like all of them, and I've used all of them, and I do use all of them. I do not use this anymore. I do not just automatically do $10 and that's it. If I do, I'll do like something like this, the hybrid approach. Okay, but mostly like the technical point, market turns, I will average in. All right, if you have questions, I imagine this is going to bring up tons of questions. What I suggest you do is you go on YouTube, you find other people that are talking about these things, educate yourself. You need to be spending more time on this stuff than you do on the entries. All right, I've shown you 3 entries. They all work very well. They're all very high probability trades. You are with the trend of the market when you're with your delta. If it's green, you go long. If it's red, you go short. You're looking for this breakout within the levels or pullback within the levels, and you're looking for stacked imbalances. All right, that's order flow. Now you need to focus on your stops, and this is really what makes you a successful trader. Okay, I hope this helps. But a lot of you might be really like disappointed, like, oh, I wanted him to give me the answer. There is no answer. It's whatever answer you come up with. I know you don't like that, but that is it. Okay, take care. I'll see you in the next video.